Hello and welcome to Life Talks Money Walks, our weekly reality check on sensible investing and financial decision making for business owners and ex-business owners living in Northern Ireland. Hosted by myself, Mark Reynolds, lifestyle financial planner at M Reynolds Financial Solutions, based in Armagh in the heart of the Orchard County. Now today, in a departure from our recent publication, A Young Person's Guide to Money, is the first in a series of short, descriptive sessions on the principle of successful investing. Today's topic, diversification. Why you shouldn't put all your eggs in one basket. We believe that diversification is an investor's friend. It acts as a security blanket around an investor's portfolio, helping to soften some of the bumps along the way. Now, sadly, in our experience, this principle is largely ignored. Not surprising when you consider the amount of investment news people are flooded with on a daily basis. Now, it can be difficult to sift through the noise and to pick out what is truly meaningful. Now, today, I would like to demonstrate how this principle can help you. To help me, I'm going to use a couple of charts to hopefully illustrate the benefits of diversification across asset groups and across regions of the world. Now, most investors out there tend to be invested in their local area, i.e., they tend to be overweight in assets like property or companies listed on the London Stock Exchange. Now, of course, your home market may seem more familiar. You might feel more comfortable if, for example, you recognize the names of stocks or assets you hold. But is it sensible to only own assets in your local market when you are targeting market returns or premiums? Perhaps it might make more sense to take a step out of your local market and say diversify more broadly and capture global market returns or premiums. How easy is it to time to invest and predict which country or asset is going to deliver the highest return in the following year? Now, to answer this question, I want to use this chart. On this chart, we can see per calendar year global market returns from a range of assets, sorted according to highest being at the top and lowest at the bottom. A question for you is, can you detect a pattern? No. You see why we call this chart the randomness of returns. So let's say, based on the returns of 2015, I decide that an investment in global real estate appears to be a good bet. Top returns in 2015 after all. What would have happened if I had overweight or concentrated my investment in global real estate? Let's take a look at 2016. You will notice that global real estate is no longer at the top. In fact, in 2 years, global real estate has traveled to the very bottom. So, by trying to time the markets, by trying to predict which market is going to have the highest return in the following period, I would have missed out on the very best return, which was in fact emerging markets. Now you can see on this page that emerging markets was the very bottom last year. So global real estate and emerging markets have switched places in 2 years. The question to ask is, who could have seen that coming? You never know what markets will outperform from year to year, so our recommendation is not to bother trying. By holding a globally diversified portfolio, investors are positioned to capture returns whenever they occur. Remember, diversification helps to take the guesswork out of investing. Next time we'll be considering other principles that can improve your investment experience. Thanks for watching.